Good morning. Welcome to Stock Market Today. It's Wednesday, November 11th, 2020. This is your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me on Twitter at @DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where I get a lot of the content for this show. We also give you daily stock ideas to consider, and that hits your inbox every trading day before the market opens. And a happy Veterans Day to any of the veterans out there who are watching the show today. Thank you for your service. Let's dive into it. U.S. equities were mixed in Tuesday's trading, though ended well off the morning lows. Sector rotation remains a key theme, with tech, discretionary, and comm services lagging while energy outperformed on the day. Treasuries were flat. The dollar was little changed on the major crosses. Gold finished up 1.2%, and WTI crude rallied another 2.7% after the big move higher on Monday. So the sector level, industrials, fins, and discretionary leading. As we said, tech, comm services underperformed on the day, along with discretionary. So just more of that rotation out of the big kind of winners and into some of the more cyclical / value areas of the market. And that's been a theme that's been playing out so far this week. As we get to the desk this morning, futures are higher. S&P futures up about 70 basis points after Asian markets were mostly higher overnight. China did close lower, however. European markets are higher, extending their recent rally. Treasuries are mixed. The dollar is stronger on the major crosses. Gold is trading flat, and crude oil is adding on, up another 3.5% to kick us off on a Wednesday morning. That starts with us wondering, is the rotation real this time? We'll talk about some of what we're seeing here. At the same time, for the major indices, we have the SPY fighting to hold the breakout. You can see it. The rally higher on Monday morning before fading throughout the day. And then yesterday was a bit of the opposite. Some early weakness was bought, and we're kind of just hovering around that breakout level. Key support 340, then 320 below that. Qs 260 remains the line in the sand for the consolidation within the context of an uptrend. The move through 280 increases the odds of the September highs, but we want to see us hold above there. IWM get some follow through, support near 160. So IWM, the big story this week, rallying through the highs seen in the January-February timeframe and continuing to build on that strength. Yesterday, we could see the spike higher to close at 172. So I think as long as we're above 160 on IWM, it looks okay. At the same time, just kind of paying attention to what's happening in and around the moving parts of the market, some of the rotation that's playing out. And we'll get to that a little bit later on in the show. Let's take a look at our market in a minute. What are we writing about today? Well, stocks turned in a mixed session with value leading growth again. Relative strength in utilities may not be bearish. Now, we touched on that yesterday, so we're not going to belabor that point. But I'm highlighting it in my note today. Large banks begin to outperform. We'll take a look at that chart. Sentiment more greedy than fearful, but not at a contrarian extreme. And as I said, futures do point to a higher open here today. Looking at the major indices now from a power bar perspective, the Dow, 3 bulls, 0 bears there after adding 93 basis points yesterday. S&P down slightly, 14 bips, 136 to 52 bulls, bears there. NASDAQ, your big underperformer, down 1.8%, 15 to 12 on the ratio. Small caps were your big outperformer once again, 797 to 209, bulls, bears. Bonds down, tick, sending yields higher, and energy was your best sector. Energy higher by 3.24%. Ratio there still bearish, but some signs of life in the energy sector of late. So something to monitor, keep an eye on. Rating here still bearish, but we're watching. According to the Chaikin Power Bar, small cap stocks and large cap stocks were bullish. Major indexes across the board, however, are mixed. Let's hit our stock of the day. We've been paying a lot more attention to the banks, highlighting the regionals. Today, we're highlighting the larger cap banks in our note. And our stock of the day, AUB, Atlantic Union Banks, has a bullish Chaikin Power Gauge rating. The trend is strong as it trades above the rising long-term trend line, and the industry group has become strong. What's interesting to me is the personality change here. We went from being a persistent underperformer to now beginning to outperform the market. So that follows the rating shifting too. Rating turned bullish back in September, but still a big underperformer. And then we start to get some outperformance. Combination of the rating and relative strength is what gets us excited here as the stock breaks out of a consolidation that's been in place. Really since the lows in March, kind of hit the lows and then chopped sideways, but now we're getting a top side breakout. So I think if you're paying attention to some of the rotation that's going on the surface, I think that if you're watching some of the more value and cyclical areas of the market, you need to be paying attention to the banks. We've highlighted them recently in our notes, highlighting them again here today and calling out Atlantic Union as a potential bullish idea for those who are looking to, maybe take part in some of the rotation that's playing out. It's anybody's guess if it's going to stick, right? We've seen bouts before of this rotation trade, only to see growth reassert, and that could certainly happen again. Some of the data points now are a little bit more compelling to connect the dots to lead me to believe that this is a little more enduring, and at the very least, taking a little bit more of a balanced approach to portfolios, where for a major part of the past 2 years, just kind of owning growth was the easy trade. I think that trade is a lot less easy now. There are no easy trades in the market, but I think that one's a lot less easy now. I think a more balanced view and a more balanced approach of what's happening in the market makes a lot of sense. So we're certainly adopting that view and highlighting some of the areas that could take advantage of that as we go forward. Let's hit our sector tracker now. Movement of the major sectors over the last 5 days, all green on the screen, which is good. Energy at the top of the list, along with financials. So those are your kind of really the top four are the four major cyclical areas of the market. Now, materials and industrials are the two that we've liked for a while. Certainly would say I'm warming to financials. We're starting to see signs of a bottoming process there on a relative basis, and we've seen some near-term strength in the banks. Energy, I'm not quite there yet, but I do think it's interesting. Some of the trends that are playing out, especially in light of the fact that energy is arguably one of the most hated sectors of the market from a sentiment standpoint. Healthcare, comms, and tech are middle of the road. And then, you have REITs, discretionary below that, and then staples and utilities at the bottom of the list. So as I've said in the past, this is a good looking board. You have your kind of cyclical leadership along with your secular growers towards the top of the list. And you have your defensives, right? The staples and utilities at the bottom of the list. Now, a lot of people have talked about utilities and the relative strength, and some people might draw the conclusion that utility strength is bearish for equities. To me, it's interesting. I don't think that's the case. As I've said, I think it's rotation out of low yielding treasuries. I'd be more concerned if staples were also outperforming, and at this point, they're not. So good looking leaderboard if you're an equity bull. Taking a look at our industry in focus now, NYSE tech services, past 6 months, been a great outperformer, leading the S&P 500 by about 18%. Power bar ratio, which looks at future potential, is strong with 8 bulls and 3 bears. It's currently ranked in the middle of the road. Number 10 of 21 subsectors that we track are some of the names there that might be compelling. I mean, you want to do some work on, right? And I say do some work, just run out and buy these things. I think you have to do the analysis. AMAT, Applied Materials, Alphabet, it's always going to be Google to me, and Baidu, BIDU. Chinese tech names under a little bit of pressure due to some regulatory news over there over the past couple of days. AMAT very bullish. Google and Baidu are bullish here at Chaikin Analytics. And as we look at the fund, we can see that it looks very much like the tech sector, like the Qs. Basically just kind of consolidating here. Notice it didn't break out on Monday, right? When small caps gapped and even the SPY gapped and some of the value areas of the market gapped up and out. This fund did not, remained within the consolidation where it stays. Now finding some support at the rising long-term trend line. And this is what I'm talking about. I don't see a complete breakdown in these tech/growth areas of the market just yet, but I do think a more balanced approach is in order. If we look at the fund, it has a bullish rating. Money flows turn mixed. It's neither overbought nor oversold. Outperforming, but seeing some diminishing relative strength in the near term. So like I said, a more balanced approach definitely seems to be a good idea, or at least that's what the data is telling me at this point in the game. Like looking at what's trending now, yesterday's S&P 500 shakers, movers and shakers are gainers and losers. DHI reports earnings and caught an upgrade today. EXR, self-storage names rebounding yesterday. They go along for the ride. DXC, nothing company specific there to drive trading. Ulta strikes a partnership with Target. Investors like that news, up 7.5%. And Lennar goes along for the ride on the DHI print. Lennar up 7% on the day. Loser side of the board, Carnival. announced an equity offering, and so did American Airlines. So some of these reopening stocks took advantage of strength on Monday and raised some cash. Carnival down 13%, American down 6%. PAYC didn't see anything company specific there. Norwegian announced earnings. That stock lower by 6.5%. And NVDA with a neutral rating here at Chaikin Analytics, down 6.3% as semiconductors were weak on the day. So again, just a lot of moving parts playing out in the market. We want to, kind of identify them, identify potential trend shifts, pay attention to what's happening under the surface of the market. But all else being equal, we have a bullish bias. Our bullish bias has been intact and it remains intact as key support levels have hold. The question is, what does the leadership structure look like? And the market's trying to answer that question right now, which is, an interesting development, which is why kind of adopting a little bit more of a balanced view. On Wednesdays, we talk about sentiment in our note, and it's become more greedy this week. Taking a look at the 13-day moving average of the CBOE equity option put call ratio, still down in those levels of excess greed and actually taking a turn lower as markets rallied this week. The VIX, after rallying back towards 40, has completely collapsed back down to the mid 20s. I guess completely collapsed is unfair, but it's collapsed, right? There were a lot of people putting on, the chaos trade, if you will, around the election. A lot of people were bidding up volatility, looking for protection for their portfolios. And, subsequent to the election, those bets are being unwound here in the near term. See the VIX falling from 40 pre-election back down to the mid 20s. So move towards greed here in the near term. If we take a look in our note, the CNN Fear and Greed Index moved back into a greed position as well. So an equity market rally will do that for you in the near term, but none of the sentiment indicators or the positioning data that we look at points to it making sense to have a contrarian view here in the moment. So leaning bullish, but for the options traders, not really at any kind of extreme that makes me say this looks a little bit overdone to the upside in the here and now, and especially the fact that you have small caps breaking out of a range that's essentially been in place for 2 years. That's kind of compelling in and of itself. I said we would talk about the banks, and about a week and a half ago we looked at the regional banks in our note. Today we're looking at the bigger banks. KBE, the SPDR S&P Bank ETF, gapping higher on Monday and holding the gap yesterday as we kind of break above those June highs. We were above a rising 200-day moving average and kind of this support turn resistance level. The polarity in the market now, we may battle there, but right now we're above it. So to me, that calls for a bullish stance, especially when you add in the fact that the RSI of KBE has moved to the upper half of the range, so shifting to a bullish regime. As we take a look at it through the lens of Chaikin Analytics, KBE does have a bullish ETF rating, and take a look at this ratio here. Amongst the holdings of KBE, there are 61 bullish stocks and 0 bearish stocks as it stands. So clearly, we want to sit up and take notice of that. We also want to sit up and take notice of the fact that on a relative basis, the fund appears to be rounding to the upside. We've broken the downtrend line, and we're starting to see some better performance, like what we would call a personality change at Chaikin Analytics, but some better performance on the part of KBE relative to SPY. So this is some of the shifts, or one of the shifts that taking place under the surface of the market that we think it makes a lot of sense to be paying attention to. We certainly are. Take a look at KBE. Take a look at some of the holdings there. There were 61 bullish stocks that might warrant some attention. And then finally, I thought this chart was interesting. The Qs, QQQ versus IWV. So the big cap tech versus the rest of the market, right? And here's that, similar to the growth value trade, became extended. Now we've consolidated with some near-term weakness below the 50-day moving average, moving towards the 200-day. But check out the linear regression slopes on a short-term basis: 21-period linear slope and 63-period linear slope, both going negative. So we've got this battle going on. Short and intermediate-term trends turning lower as we begin to near a fight with the long-term trend. So if the Qs are going to reassert leadership, we would want to see that soon. That's going to wrap us for today. Have a great day, everyone. Take us for a test drive. I will be back with you tomorrow.